Welcome to TaxLawGH and welcome to our introductory session on the basic principles of income tax. This is a very important session because what it does is it introduces you to the very foundational concepts you need to be really grounded well in. That will serve as a strong foundation, a strong footing in subsequent concepts we'll introduce in this topic of income taxation. Let's look at a number of key concepts and then we can progress from there. The very first concept we'll look at is the concept of the person. What does the term person mean in tax? In income tax, when we say a person, it could mean one of two things. It could either mean an individual or an entity. What this means is what you and I know a person to be is not the same when we say person in tax. We can see someone, we can meet a friend on the street and say this person or this guy is a bad person. This lady is a very pleasant person. We are used to using the word or the term person for individuals, for human beings, for natural persons like you and myself. In tax, or during the course of this session, during the course of your studies in taxation, income taxation in particular, and other taxes as well, anytime you see the term person, what should come to your mind is an individual or an entity. So anytime I say taxable person or resident person, in your mind, you should read it as resident individual, resident entity. I'll take that again. Anytime I say a resident person in tax or a non-resident person in tax, what that means is read it as resident individual or resident entity. So it means the word person carries two possible meanings, individual or an entity, right? You will realize on the far right that we have references and further reading. What I've done is I've put on that side the references and the relevant pieces of legislation for those who probably want to do further research, read a lot more about the topic. But because this session or these sessions are focused on providing you with a solid foundation to pass your exams, we will not focus too much on the pieces of legislation, the section numbers and all of those. I'll take this again. An individual or a person could mean an individual or an entity. You can find this in section 133 of Act 896. An entity could in turn mean a company, it could mean a partnership, it could mean a trust. We'll look at all of those in subsequent sessions. Now that we know who a person is, let's look at concept number 2, which is the concept of the year of assessment and the concept of the basis period. A year of assessment in tax essentially means the calendar year, the same January to December that you and I are used to. So anytime you hear me say, or you hear anyone say, or you read anywhere in tax, the term year of assessment, it's the same year you know. So we are used to going to church on 31st of December to do our various crossovers, jump overs, run over services. That is in line with the belief that the year starts in January and ends in December. In tax, the year of assessment is the same as the calendar year, which is January to December. Another important concept you need to acquaint yourself with is the concept of the basis period. You'll be seeing from time to time as we move along terms or expressions such as basis periods ending within a year of assessment. There'll be an expression like that as we progress. A basis period is also a period, just like a year of assessment. Just that a basis period is a more specified, a more customized, if you can use that term, a more customized period for a person. Remember I said a person could mean an individual or an entity. So for individuals and partnerships, their basis period is the calendar year. Let me take that again. For individuals and partnerships, their basis period is the same as the calendar year. So in essence, an individual or a partnership has their year of assessment equal to their basis period. Very important to remember this. Companies and trusts, on the other hand, have their own customized or specified basis period. Companies and trusts use their own accounting year as their basis period. What this will mean for you is there are different companies that do not even follow our calendar. We are all used to December being the last month of the year. But for several multinationals, their year starts in March and ends in February. There are some multinationals have different years of assessment. That's the important takeaway from here. Not everyone follows the January to December that we are all used to. So a company's chosen accounting year will be their basis period. So the concept or the takeaway point here is that for companies, their year of assessment will not necessarily equal the calendar year. The only instance in which a company or a trust will have their basis period equal to the year of assessment is for companies and trusts that maintain the January to December calendar as their accounting year. So take note, takeaway point from here is that the basis period of a person differs between individuals and partnerships and between companies and trusts. Individuals and partnerships use the calendar year. Companies and trusts use their own accounting year. And once again, the reference is on the far right for those who want to read further. Still on the concept of year of assessment and basis periods, let's look at the situation, the scenario where a company would want to change their accounting year. Remember, I said companies and trusts are allowed to use their own accounting year as their basis period. So if a company decides to change their accounting year, what are the procedures? What can they do to get this done? It is possible for a company that wants to change their basis period to write to the Commissioner General, to apply to the Commissioner General for approval or for permission to change their accounting year. The Commissioner General reserves the right to either accept or reject this application for the change of the year and the basis period or the accounting year. In addition to approving, the Commissioner General will usually include or attach terms and conditions that the company must comply with in order for the approval to change the accounting year to remain valid. What this means is that it is a conditional approval for you to change your accounting year. So let's say a company that uses the calendar year of January to December as their basis period or as their accounting year. Probably because their headquarters in China changes their group year end from December to, let's say, November. And because the company wants to align local reporting with global or group reporting, they write to GRA or they write to Commissioner General and ask him for permission to change the accounting year. The Commissioner General can approve and attach terms and say, if you flout A, B, C, if you don't do 1, 2, 3, or if you do X, Y, Z, then I will revoke the approval I gave you. So that comes to the next point on revocation of approval granted. Where you break any of the conditions or you fail to comply with any of the rules or conditions attached, the Commissioner General reserves the right to say he has changed his mind. I was the one who told you can change from December to November. I have taken that power away from you. You have to go back to your old accounting year. So it's important to remember that the only condition under which a company can change their accounting year or their basis period is by applying to the Commissioner General for approval and complying with every single condition that comes with the approval. The effect of non-compliance with the approval requirements is once you break any of the rules, you risk having your earlier approval to change your date or a year of assessment, your basis period. You risk having that being cancelled. Now, what would be the impact of a company that successfully changes their basis period what will be the impact on their tax compliance? Where a company changes their basis period or their accounting year successfully, it will also change the time the company is required to pay their taxes by installment or on assessment. It depends on the circumstances. I'll give you an example. A general rule, I'm sure you may be aware, if you are not, you are learning now, companies in Ghana typically pay their taxes on a quarterly basis. What this means is, at the start of the year, you typically make an assessment of what you think will be your tax payable for the year. So, as I'm recording this, today is the 4th of January, 2021. A company that has a 31st December year end has to, by the end of March this year, 2021, will have to file an assessment with the GRA. It's called a self-assessment or a statement of estimated tax payable, telling the GRA that for this year, I believe I'm going to make probably 1 million cedis, and the tax payable on that is so and so amount. And based on the tax payable, I have divided that on a quarterly basis, and I'm paying my first installment, right? So installment taxes are paid at the end of each quarter. What the last point here is saying is that for a company that has changed their basis period or the accounting year, it will also affect when they make their quarterly payments. So, for example, a company that has a 31st December year end will pay their first installment payments at the end of March, right? Let's say the company writes to GRA to change their accounting year to November. What that will do is it will shift the payment 1 month earlier to February instead of March, right? So we start counting tax compliance deadlines from the new date the company got an approval for from the GRA and not the old date. So take note, where you are granted the approval to change your accounting year, it will also affect when you comply with your taxes in Ghana. Now let's come to another important concept, another important principle, which is the imposition of income tax. How is income tax imposed? Under our Income Tax Act, references on the right as usual. The basic takeaway point you need to have from here is that income tax is payable on 2 levels, generally, right, at the very foundational level. Income tax is paid by a person who has chargeable income for the year and a person who receives a final withholding payment during the year. I'll explain the concept of chargeable income in the next few seconds or minutes. Final withholding payment, I'll address it during the topic on withholding taxes, but let me address that now so at least you have a fair idea. A final withholding payment, as the name implies, is final. It is a payment and it relates to withholding, right? So we've broken the words down. We know it's final. We know it relates to a payment that had to do with withholding, right? An example is this. If, let's say, you receive dividend, we should be aware that dividend is taxable or it's liable to a withholding tax rate of 8%. That is a final tax. What does final mean? Final means once that income amount gets to you net of taxes, you do not owe any further tax liability or any further tax obligations with respect to that amount. So let's say I receive dividend from a company I've invested in. They withhold 8% and they pay me the amount net of taxes. I do not need to include that amount in any of my tax compliance or tax assessment requirements for the year at all. Why? The reason is because it is final. Final means it has satisfied all my tax liability at the point of withholding, right? Once we treat withholding tax as a concept, we'll go into further detail. But for now, remember that the final withholding tax or final withholding payment is simply a payment that fully settles your tax liability at the point the withholding occurs. You don't have to do any other further compliance or assess any other taxes on that amount after it is withheld. So the total amount of income tax payable will definitely be the sum of the 2 amounts above. You add the tax on the chargeable income and the tax on the final withholding payment. The sum of the 2 is what will give you the income tax payable by a person for a year of assessment. We've mentioned chargeable income. We've mentioned final withholding payment. Now let's look at income tax payable on a person's chargeable income. Very important. You can see here We are saying subject to special rules concerning something called modified taxation. I'll explain that in the next slide. You can find that in the second schedule of the Income Tax Act if you're interested in further reading. We are saying income tax payable by a person who has chargeable income is calculated by applying the relevant rate of income tax, which you'll find in the first schedule of the Income Tax Act if you're interested, to the chargeable income, and then deducting any foreign tax credit allowed to that person for the year. Let me explain. The relevant rates will be found in the first schedule. It is a first schedule that tells us that companies in general are liable to a corporate income tax rate of 25%. It is the same first schedule of the Income Tax Act that tells us that mining companies and upstream oil and gas companies are liable to a corporate income tax rate of 35%. Once you go to the first schedule, what we are saying here is pick the relevant rate there and apply it to the chargeable income of the person. And then after getting that amount, you are allowed to deduct a foreign tax credit allowed to that person. Let me explain it basically here. When we treat international tax, we would look at this in more detail. But a foreign tax credit, what you can take away from here is that it is possible for a person to earn income outside Ghana and be taxed on that income outside Ghana. As you realize in our subsequent sessions on residents, you realize that if you're a resident individual, you end up being under a system called the worldwide system of taxation. It means once you're a resident, any income you earn, no matter where it is earned across the world, may be taxable in Ghana. What this means is you may have been doing some business in China. The Chinese tax authority withheld tax or taxed you on that income. You brought that income to Ghana, and the Ghana Revenue Authority wanted to tax you again. Under the concept of a foreign tax credit, you may be allowed to get a credit for the tax you paid, because GRA will tax you anyways on the amount you brought into Ghana because of the worldwide concept. And then they are saying, or we are saying over here, that you can deduct the amount of taxes you paid in China before we arrive at the final tax liability you have in Ghana. This is called a foreign tax credit. So if you ever forget, foreign means it's foreign, it's outside Ghana. Tax credit means you are going to be credited with a tax amount, right? So remember, foreign tax credit is essentially a tax you incurred outside Ghana that you are going to be given a deduction of or a credit in Ghana. I'm careful of using the word deduction because once you enter international tax, there is a separate concept called deduction for international taxes and double taxation agreements. And then we have a separate concept called tax credits, right? So we'll look at that subsequently. We've looked at the imposition of income tax for chargeable income. How about for final withholding payments? If your guess was as good as mine, it is essentially applying the relevant rate to the final withholding payment. So once again, when you go to the first schedule of the Income Tax Act, that is where you find that dividends are subject to a final withholding tax rate of 8%. So we are saying here that go to the first schedule, pick the relevant rate and apply it to the final withholding payment to arrive at the income tax payable on final withholding payments. Remember, I said that the total income tax payable for a person or by a person for a year is the sum of their income tax payable on their chargeable income and the income tax payable on any final withholding payment. Remember this, right? Then let's look at income tax payable on or under the modified taxation system. Remember I mentioned the second schedule of the Income Tax Act. The second schedule says that for an individual, their assessable income from a business may be subject to something called the modified taxation rules. As the name implies, it is not normal, it is not usual, it is modified. It has been amended, it has been changed. If you read the second schedule of the Income Tax Act, don't bother reading it if all you want is to pass your exam. We are saying here that the modified taxation rules apply special tax rules to certain people, specific people who undertake certain businesses and have certain income thresholds, right? We won't go into the details for now, but remember that for an individual, their income from a business may be subject to the modified taxation rules. Remember, it's individual from a business. Take note. We've come this far. let's see how much you've learned. Let's look at some concept checkers to see how far you've been following. Our first question is this. The year of assessment for an individual and a company are the same, true or false? You can pause here and think through it, then we continue. Okay, so the year of assessment for an individual and a company are the same. Yes, it's true. Remember we said the year of assessment is the same as the calendar year from January to December, right? So a company and an individual have the same year of assessment. It's not the same as basis period, separate concepts. So this is true. The next question. An individual can change his basis period upon making an application to the Commissioner General. Is this true or false? You can pause, you can type your answer down there in the comments. You can let me know what you think. Is it true or false? This is false. Remember we said it is a company that can write to the Commissioner General of the Ghana Revenue Authority and request for approval to change their accounting year or to change their basis period. And this approval will come with what? Conditions they must comply with. If they comply, then this will affect when they are required to what? Make their tax payments or comply with taxes. So this is false. Individuals cannot change their basis period. Individuals have their basis period equal to the year of assessment, which is the same as the calendar year, which is the same as from January to December. Final concept checker, I guess. The applicable rate of income tax can be found in which portion of Act 896? I mean, this question, all of you should get it right. Is it A, the second schedule? Is it B, the third schedule? Is it C, section 1? You can pause, have a think through it, and then let's see if you got it right. The answer is obviously B, which is the first schedule. I've mentioned so many times that when you go to the first schedule, that is where you will find the various rates of income tax. So at this point, let's break here and we'll take key concepts, second part, in the next video. Don't forget to hit the like button if you love this and share this video within your network.